And a happy St. Patrick's Day to you all. It's been an interesting week. The Fed raised the overnight cost of money by 0.25%, and nothing happened. Mortgage rates, if anything, went down slightly, which has created this alternate universe of explanations that all sound like Sean Spicer. They keep it just as simple as possible. The day after election, long-term interest rates went to the moon. Overall, they rose almost a percentage point. And that jump was predicated on the assumption that the Trump administration would roll out these huge stimulus programs. We'd have a big tax cut, we'd have big infrastructure spending, we'd have business-friendly tax reform, and on and on. We've stayed in the same long-term interest rate spot since really middle of November. That's a long time. I mean, 4.5 months is a long time in the bond market world. I'm sure there are conflicting opinions out there, and I don't mean to offend anyone, but the way the Trump administration is going, they're not going to get anything passed of any kind that matters to the economy. The chaos is compound, but most of their ideas are not particularly good to begin with. They're extreme ideas, even for the Republican Party. They're way out on the right side. Things that will pass the House won't pass the Senate. Things that will pass the Senate won't pass the House. So all of this is just dead in the water. Now, under normal circumstances, the post-election spike would be dribbling off and we'd be going back down into the threes where we were. But all things are not equal. The Fed has tightened now twice since the election. Once in December, once this week. The Fed is filling in behind the rate increase. The Fed's most recent tightening was not enough to knock long-term rates up further. And even the next one may not be enough to bulldoze them, push them up further. The one after will do it. So stay on guard. The Fed's process of roughly 3/4 point increases in the cost of money this year, next year, and the year after, mortgage rates are going to go up gradually. There isn't any way to know how far they go. There isn't even any way to know if the Fed tightens a quarter, do mortgage rates rise a quarter or an eighth or more. But the likelihood is that mortgage rates rise slower than the Fed rises. And the gap between the two, short-term interest rates and long, gradually closes. The graphs that are attached to the copy near this video are worth looking at. The visuals will help you. Every recession since the 1960s has been preceded by a moment when the Fed rose above long-term rates. It's known as an inversion. It's a lead pipe cinch. It's one of the few events in finance which has 100% predictive value. Every time short-term rates rise above long, we have a recession. Every recession is preceded by short-term rates above long. With any luck, we're years away from that event, but we are not years away from the Fed literally bulldozing long-term rates higher. There's another circumstance when the Fed is late. It's behind. It tries to let the economy go hot for too long. When that happens, the Fed staying put here, long-term rates run away from the Fed. It's not happening this time. The movement in long-term rates last fall was this weird election event that should have reversed but can't because the Fed's coming, and it is coming. And a happy St. Patrick's Day to you all.